This presentation deals with debt and investment strategies. It is aimed at looking at the practical mechanics of using debt either as an investment security or as a tool for magnifying returns, and looks at the various strategic aspects of how to use debt in these two capacities. In this presentation, we'll be taking forward some of the elementary introduction to capital markets that you would have done in your finance subjects, and also developing further your understanding of the accounting treatment of debt and its taxation. But first I want to return to the accounting equation. You may have come across this equation in your introductory accounting courses. The accounting equation is really the equation which lies behind the balance sheet, and it describes the way that the assets that a firm holds are funded either by debt or equity. The accounting equation is important because you find that it works all the way through your system of accounts, but we're also going to be using it for what it tells us about the way that finance works. First of all, we can see that any firm only draws a profit from the effective economic use of its assets. However, all the assets come both as offering a potential profit or return, but also that profit and return carries a risk. These are denoted by the green and pink bars on the diagram respectively. When we look at the right-hand side of the equation, we see that the distribution of return and risk, which comes from the profits made by the assets, tends to be redistributed between debt and equity. We see that the return to debt is somewhat lower than the return on the assets. This is the basic requirement for the benefit of leverage or positive gearing. In all cases, any effective leveraging strategy must have the overall return from the assets made up by their operating profit and their long-term growth prospects. That total return must exceed the cost of debt. And so the green bar, the return to debt, the interest payment, will necessarily be lower than the return on the assets. Otherwise, the funding strategy will be a failure. When we go to the equity, we find that the return is magnified. It is higher. And so the equity holder, the shareholder in the firm, earns a higher rate of profit from the application of those assets than would have been achieved without debt. When we look at the distribution of risk, we find that the debt provider takes a minimum of risk, and this is achieved by taking security over the assets and maybe other strategies for securing the loan. And so while the bank may be concerned about its risk, the risk is in fact quite small compared to the latent risk of the assets themselves. By contrast, the equity holder holds that balance of risk, really magnifying risk as well, which is shown as the pink bar associated with the equity. What we can see from this simple diagram is that the capital structure expressed through the accounting equation also distributes income and risk. But the important thing to be mindful of is that the redistribution of risk does not necessarily match the redistribution of return. That is, the relative effectiveness of the use of debt is something that needs to be carefully considered and strategically managed in order to be effective. In some cases, the increase in return may outweigh the increase in risk, but on others, the increase in risk might make the increase in income rather foolhardy. Careful forecasting and modelling is very necessary to be able to spot the difference. The redistribution of risk and return as a result of debt means that an investor is faced with the question of either investing in equity, which is likely to use debt to magnify profits, or to invest in fixed interest securities as a lender, in which case they enjoy the lower return and lower risk. To understand some of the factors that influence which side of debt is attractive to be on, we can look at the effect of tax and the overall incentives towards saving or borrowing. Interest costs of borrowing are tax deductible, and so this means that your net after-tax interest expense is reduced because of that tax deduction. Mathematically, it's equal to the interest rate multiplied by 1 minus the tax rate. In the case of the present, where many people have a marginal tax rate of 37%, and if we look at the interest expense associated with a standard home mortgage, which is around 7.8%, we can see that after tax, the cost of borrowing is only 4.91%. This means that so long as you're borrowing for some commercially profitable venture, the actual cost of debt is considerably lower than its apparent cost, which is an incentive towards borrowing. As well as this, if the borrowing is applied to an investment that has strong capital gain expectations, such as real estate is believed to have, the leverage advantage due to the after-tax effect is doubly benefited due to the fact that much of the profit from the investment comes as capital gain, which itself only is burdened with half the rate of tax that regular income tax is. And this means that the tax benefit of borrowing is considerably better than the tax burden of the eventual capital gain. That is, it's an incentive to borrow as much as possible when the profit is going to come back to you as a capital gain, because the capital gain is only taxed at half the rate. By contrast, interest income is taxable, and this means that if you're a lender, you must pay full income tax on your lending income, on your interest income. One particularly unfortunate aspect of the tax payable on interest income is that the depreciation of money due to inflation is not a tax deduction. By this we mean that if I lend $100 and at the end of, say, a year, I've lost 3% of my money's value through inflation, I don't get to deduct that $3 loss from the apparent income of my interest. This means that the net after-tax real income is equal to the interest rate times 1 minus t, because I pay tax, but also less the inflation rate, that here we're referring to by the letter P. In practice, if inflation is running at 3.6%, which it has over the last 12 months, if I am able to lend my money earning the 7.8% of the typical home mortgage interest rate, the real after-tax interest income is only 1.31%. Most lenders are not able to earn the full 7.8% that people pay when they're borrowing for home mortgages. A more realistic interest income is the maximum currently available for fixed deposits of around 6.8%, where the net real after-tax interest income reduces to only 0.68% per annum. What we find is that if you are lending and earning an interest income of less than about 5.71%, you are actually losing money by lending it. Considering most current accounts earn interest rates considerably below 5.7%, it means that all of those deposits in banks tend to be losing money for their depositors. Hardly an incentive to save. We can go into other areas to find that there are many places where the community has learnt that it is more effective to be a borrower and not a saver. But certainly this illustration using the tax rules illustrates one very potent aspect of that community disincentive to save. By contrast, the social benefit, the economic ideal, is actually to encourage saving throughout a person's working life in order to provide for retirement. However, simultaneously, there is an advantage in discouraging intergenerational savings because this causes eventual wealth polarisation, which has been associated with economic collapse and political unrest. In recent times, the social objectives of encouraging savings through the working life have been realised through policies towards encouraging superannuation. And you will see that the emphasis that's placed on superannuation, both in terms of the legal necessity for employers to allocate amounts or payments to superannuation funds, and also the tax benefits from saving into superannuation schemes, are all directed towards encouraging some degree of saving in the community. However, it still remains evident that there are many real and psychological incentives that have caused the majority of people in Australia to tend towards minimising their savings and maximising their borrowings. While the foregoing is a fairly strong argument in favour of borrowing rather than lending, we find that not all debt is the same, and likewise equity investments vary quite markedly as well. While generally debt investments have lower risk and also a lower return, the actual levels of risk and return do vary with the quality of the debt. And so we have debt instruments, debt securities, rated by credit rating agencies such as Standard & Poor's to give an indication of what the risk level is, and from the assessed risk level, the market tends to allocate the appropriate level of return. In other words, the expected interest rate that is needed in order for investors to buy those fixed interest securities. Of the fixed interest investments available, the lowest risk are considered to be government debt or government bonds. These are considered to be virtually risk-free. In Australia, Australian Commonwealth bonds carry a AAA credit rating, which is the highest credit rating available. While there are many countries that also have AAA credit ratings, there's also a large number, and in fact an increasing number, that have lost that highest level of risk rating. Equity investments also have a spectrum of returns and risks, and while they generally have higher returns, this is not always the case, because in some cases more secure equity investments, referred to as blue chip investments, in some cases have lower returns and lower risks than some of the more adventurous and risky fixed interest securities or junk bonds. The result is that there's quite a spectrum of possibilities in both debt and equity that gives a variety of returns from rather conservative amounts with government debt right up to adventurous high expected returns with speculative equity investments, and all of those have a spectrum of risk associated. One question for the property economist is to be able to locate real estate within the debt equity continuum. Generally, what we can conclude is that unleveraged property, in other words, property without the use of debt for its acquisition, is probably comparable to modest levels of debt, somewhere between debt and equity. The risk associated with property investment increases significantly as debt leverage is brought in. The advantage of debt leverage is that it increases return, but at the same time it will increase risk. This spectrum of possible returns and risks, spanning from conservative debt instruments to speculative equity, can be conceptualized as lying along a line that connects risk and return. This relationship is known as the capital asset pricing model, and it suggests that all investments fall on a single line. The capital asset pricing model, or CAPM model, is used as a pricing model for the pricing of risky financial assets, and it includes all financial assets, that is, debt, equity, property, and so on. And conceivably, every way of investing money can find its place somewhere on the capital asset pricing continuum. It's really based on a very simple notion, a simple truism, and that is that the rate of return will increase as the risk increases. This means that the extra return is really a form of risk insurance for the investor. So the investor expects to be rewarded for taking risk in order to be able to pay for the costs if the investment falls over. Many of you will be familiar with the CAPM line from introductory finance courses. However, here we want to take the CAPM theory and apply it further to property and debt investments, and looking at what it tells us about investment strategies. You'll recall that the CAPM line relates risk and return, and it uses the quantity of beta as the measure of risk, where beta is based on the past variance. Variance, you'll recall, is the standard deviation of a sample squared. So it's a measure of spread. The CAPM line is notionally a straight line, and it's calibrated as the line that joins 2 points. That is the return on government bonds, which are considered to have zero risk, and the return on that basket of shares that is the All Ordinaries measure on the Australian Stock Exchange. And by definition, the return on All Ordinaries is also given a unit beta measure, and all other risk measures, all other betas, are measured relative to the All Ordinaries risk level. The CAPM line is evaluated for every market, and so if you're preparing a CAPM analysis in the United States, you would use the Dow Jones or a similar share market index applying to the local market. Fortunately, beta values are available for all public listed companies, and especially since it is considered that the beta values are similar for organisations involved in similar types of business, you can estimate or get a value of beta for a private company by looking at comparable public companies, and that will give you a good start on its beta, simply because you're operating in a similar industry. Looking across the CAPM line, we can see that the low beta areas, the low risk areas, tend to be dominated by debt, whereas the higher risk levels tend to be dominated by equity. However, we do see this a significant overlap in the low beta area between good quality equity and poor quality debt. To locate property within the CAPM line, we can suggest that unleveraged property probably is on the low end of equity and somewhere in an area which is likely to be comparable to debt. Also notice that we've listed here on the CAPM line an estimate of development. Development is a high profit property investment tending to run over the short term, but is also associated with high risks. And so we're choosing to locate development in the speculative end of the equity spectrum. Now, because betas are worked out in terms of a statistical analysis of the variance of returns from public listed companies, to be able to set a beta on any particular property investment is very difficult. This applies both to straight property investments, say leveraged or unleveraged, but also on development projects, because each development project tends to be unique. However, we can look to companies that specialise in investment property, such as investment trusts, or REITs as they are beginning to be called, and also in development companies such as Stocklands or other companies that earn a major part of their income from development activities. The CAPM model is a very important model because it is both used by stock exchanges and share analysts. It has the advantage of being based on a simple truism, and there has been significant evidence to suggest that equities in similar types of ventures exhibit similar betas both historically and between markets. As we've mentioned, betas also appear to be transferable between listed and unlisted securities, which is very useful considering we do have the published betas for ASX listed securities. However, the CAPM model is not without considerable limitations and criticisms. Especially it's been found that the results have not been precise. That is, there's considerable mispricing of securities. There are many securities that don't sit neatly on the CAPM line. Also, we find that historical consistency is problematic, and we'll be looking at that further when we consider the question of risk. The question of risk itself is complicated by the fact that the use of the statistical parameter of variance is quite problematic. The basic question is that while variance is a very convenient statistical tool to analyse or to evaluate risk, there's a major question about whether that really is what risk means. It leaves us wondering exactly what risk does mean. And this notion of risk as the uncertainty as to what return we're going to get into the future is not absolutely satisfied by the historical variance. If nothing else, it infers that the market is going to perform in the future in the same way that it did in the past. And that is not very well supported. If variance is risk, then the market itself should use it for more than simply CAPM studies. But it appears that pricing does not follow the variance as the ultimate measure of risk. Next, risk perception is not necessarily linear. This means that as the market perceives risk increasing, the aversion to investing in a particular investment may not increase linearly. It's likely that the return expected for a more risky investment is higher than what would be expected from a linear relationship. That means that investors expect more than a proportional return for any proportional increase in risk. This is not accommodated by the capital asset pricing model. Lastly, the question of the future not being like the past. In many cases, the influences of the past are very different to the prospective influences into the future. The CAPM model doesn't take into account these extra factors. It seems that almost constantly the world is changing. The future is not going to be like the past. It never has been and does not appear to be now. There's really no evidence, and there can be no evidence because we can't concretely forecast into the future. A sober appraisal of the international finance situation at present, and even Australia's economy, would recognise that the long-term future of the international economy is going to be considerably less robust than it has been over the last generation or so. And we'll be looking at this later on. At the very least, it suggests that this expectation of 10 years of history being an adequate indication of where the next 10 years is going to go is hopelessly naive. Overall, this suggests that while the CAPM is very useful as a conceptual tool, it should not be relied on too rigorously in predicting where pricing and the location of particular securities should be made. As a conceptual tool, the CAPM model does achieve a very useful outcome in the minds of investors. It does make us aware that risk and return are related, but also that there is considerable mispricing. Overall, the obvious investment strategies are to purchase investments where risk is overestimated by the market. That is, if the market considers that some particular investment is very risky and therefore will price it down despite its expected return. If you consider that the risk is somewhat lower, you will realize that that investment is worth considerably more than the market will price it. Also, one should hedge where the hedge cost is based on undervalued risk. This is because the hedge cost is based on the estimate of risk. It will rise as risk rises. And so if the market considers that the future is going to be plain sailing and you have good cause to believe that it won't be, there is a profit to be made by hedging those risks. Generally, between these two strategies, we can see that success relies on the successful identification of misvaluation in the market. A way of identifying misvaluation in the market is by the use of the Sharpe Index. The Sharpe Index is a development of the CAPM model and is a useful conceptual tool for looking at the appropriateness of risk-return combinations. The Sharpe Index evaluates the attractiveness of offline securities by evaluating the ratio of the actual return, which in this diagram is shown as the quantity A, compared to the CAPM return calculated using the securities beta, which gives us the return C on the diagram. While we have to be wary that the numbers here will not give us a full picture of the security, it certainly gives us an indication of where we should start to be doing further research. The Sharpe Index is relatively straightforward to evaluate if the returns and risks are understood. In the example here, we're looking at a security that is exhibiting a 10% return and is understood to have a beta of 0.8. However, if the CAPM suggests that a beta of 0.8 should have a return of 8%, it means that the investment is offering a return of 10% divided by 8%, or 1.25 times the CAPM return. And in this case, the Sharpe Index is 1.25. Sharpe indexes of over 1 are considered to be good buys. Sharpe indexes of less than 1 are considered to be assets that you should not buy at all. We mentioned that the numbers aren't everything. It's important to be aware of the hidden issues that lie behind the numbers and make it rather foolhardy to rely too strongly upon them. Generally, anything that has not yet caused profit volatility is likely to be an issue that will upset the apparent Sharpe Index attractiveness. These will include things like management or failure to invest in future technology or maintain adequate inventory or liquidity levels. Socially, for property, this can include infrastructure investments and even population directions. Leverage changes are also a partially hidden change that may change today and cause a difference in risk. Overall, in an efficient market, security prices should all revalue to meet the CAPM line. And so if we do identify an investment that has a Sharpe Index above 1, then the market should buy those shares and therefore run the price up, which dilutes the Sharpe Index back towards the CAPM line. For property, the value should adjust similarly, and as demand changes, the property should move closer to its appropriate level. While the CAPM line is the appropriate conceptual tool for the equity markets, it's a little more difficult to apply to property where we have the valuation profession as the most capable analyst to be able to say where property value should be. Although this then places upon valuers the difficult task of determining between the expectation of a future sale, which may be ignorant of certain key facts of a property's future financial value, versus that future financial value as expressed as the present value of the future rental streams. Historically, valuers always aim to give a prediction of the market price that will be achieved and have been reluctant to comment on the investment value of a property. However, when times are difficult, such as after a market crash, often purchasers or even banks tend to be critical of the valuer's prudence in merely giving an estimate of the expected market sale price and not notifying the client that the property in fact doesn't have the underlying financial strength to be able to support the values that the market may be realising at present.